So our topic this morning is managing cash for growth. And in my mind, this is among the very most important topics for angel investors, because almost every entrepreneur that I've ever worked with thinks what he has to do is make his business profitable. And that's wrong, because you can be profitable and you can run out of cash. So profits is the wrong target. I'm on a board right now where we have a fast-growing business that turned profitable in November. And the entrepreneur just can't quite get his head around that I have to manage for cash, not for profit. And we keep running out of cash and having to slow down the growth rate because we're not managing to the working capital needs of the business. So it's a real challenge. And of course, when a business really runs out of cash, if there isn't somebody standing by in the wings to write another check, then it's very bad news, right? So we're going to do this session by using the Butler Lumber case. Now, some of you have read the case, I think. If you've read the case fully, can I see a show of hands? Okay, so some have not. So I think we should, it's very short, we should take some time to read it. So I'm going to split the room into two halves. You guys at these two tables, you are the banker, all right? So your job is to decide whether or not you're going to give Mr. Butler the new, larger credit line he wants. And you guys are Mr. Butler as we do this, right? So I think the thing to do to start off is to read the case, and once you've read the case, then we'll start diving into it, and we'll figure out what we're going to do. Okay, so could we take 10 minutes for those who haven't read it to read it, for those who have, maybe you could start looking carefully at the numbers and get a sense for what's going on in the business. First of all, why does Mr. Butler need more money?
Fund expansion.
To fund expansion.
Fund growth.
Okay.
He's up against the wall. He's not able to finance with current credit limits. His requirement for capital to grow the business.
So is it a profitable business?
Yes.
Yeah? And it's growing?
Yes.
Yeah?
Growing by sales,
Its sales are growing?
but not profit.
Are profits growing?
No, profits are actually almost coming to zero. They're approaching
Well, they're small, but are they growing?
They were growing till 1990.
But also, he's giving more than liberal credit. Profitability is not profit is growing. Profit is growing. Profitability
Profit is growing, right?
should grow. This is trended.
Yeah, we have profit data, right? It's gone from 31 to 34 to 44. That looks like it's growing, right? So why does a profitable growing business need more money? Don't profitable growing businesses create the money they need?
If they
Could-
grow outside of their,
he's growing outside of his.
no, so money can either go to working capital, which tends to be 90% of problems any growing company face. Right? So your debtors and credit cycles don't match. You have to give out more credit to have more sales. So your clients get bigger, they demand more credit, and then your capital gets sucked into working capital. Your free cash flow gets sucked into working capital, and you need more working capital.
Aha.
Hence, we don't have the cash flow statement here.
Ah.
With the cash flow statement, the free cash flow would be negative.
Inventories and receivables.
So let's make one, shall we? So I want to give you some simple tools. It looks like some of you probably are pretty comfortable doing these kind of things already, but perhaps I'll give you these pages, so if you want to make some notes on them, you're welcome to do so. Okay, so here's the page I put up there. So these are, for those who aren't normally used to looking in detail at financial statements, these are some simple tools that you can all do with a cocktail napkin and a calculator. You don't need Excel, you don't need a CFO to do what I'm going to ask you to do. So the first thing I want to know, since he's running out of money, I want to know, well, where's the cash going? Is that a reasonable question to ask? Yeah?
Accounts receivable obviously.
So in order to find that answer out, we can create a little statement, a cash flow statement that shows the sources of funds and the uses of funds, right? Okay? So this is a really simple thing to do. Here's what I did here. I took the change in the balance sheet from 1988 till 1990. So I'm taking these two columns, and I simply subtracted one from the other on every line. And I put that change number in this column. So for example, 270 subtracting 348, that gives me 78, right? Or 64 subtracting 50 gives me 14. And for the moment, I don't worry about whether it's plus or minus. I just figure out the difference and I put it in a column. And then I ask myself, okay, once that's done, I have to take each of these numbers and move it into one of these two columns. So does that number mean it was a source of cash to the operation of the business, that change in the balance sheet number, or was it a use of cash to the business? And that's mostly easy to do on a common sense kind of basis. So let's start at the bottom. Net worth went from 270 to 348, so it increased by 78,000. Is that a source or a use of cash? That's easy, right? It's a source. Okay? We go up to the next line. Long-term debt went from 64 to 50, so we paid our debt down. Is that a source or a use? It's a use, so we put it in the use column. Accrued expenses. That's probably things like payroll that we owe people but haven't paid them yet. Went from 24 to 39. What is it? It's a source, because effectively our people, if we haven't paid them, are loaning us that money, right? Until we pay them. Accounts payable have gone from 124 to 256. So our suppliers are letting us use their money. Another source, right? Next one, Mr. Stark. His note went from 105 down to 0. We paid him off. That is a use of money, right? So this is really very simple to do, right? It's intuitive. The only one that's a little tricky is when you get up to cash. We'll do the rest of them, though. So 233 here, notes payable to the bank, went from 0 owed to the bank to 233 we now owe to the bank. Okay, so that's a big source of cash. Thank you, Mr. Banker. Then the 31 change in property, 126 to 151. Maybe he bought a couple of forklifts or something, right? It's a use of cash. Inventory went up from whatever that number is, 239, is it? He had a 418. Big growth in inventory, used some cash. Accounts receivable went way up from 171 to 146. Used some cash. And then cash went from 58 to 41. Is that a source or a use? Cash went down, right? So somewhat paradoxically, that is a source because the cash balance went down. That means you used some of that cash to operate the business. But that's the one that's always tricky to know. Whenever you do this, the cash is tricky to know whether it's a source or a use. So a good way to find out is to put it in one column and add up the column and see if it balances. Because there's a name of this statement. It's called a balance sheet, right? So if you put cash in the wrong column and it doesn't balance, put it in the other column until it balances.
But if you have a negative cash, it is a source, and you're funding it.
Do you mean it? We don't have negative cash here. We have positive cash.
Cash is reducing.
Cash is reducing
Negative. You're going to fund it.
You freed it up for putting it into
to put it into the business. That's right.
When you've taken accounts receivable and inventory and that has gone up, that's a use. This is also a current asset. So if it's gone down, it's a source.
What if the cash would have increased from 58 to?
It would have been a use.
It would have been a use. It would go in the other column. Yep.
Because it's an overdraft account?
No, it's not an overdraft account. It's just
Cash in hand.
it's a cash in hand. Yeah, it's your current account, the cash you have in your bank. Okay?
So the use of cash is just to increase your cash balance. Is that what
Well, no.
if you have a positive,
Cash went down from 58 to 41,000, and we used it for something, right? Now, VC, we don't actually know whether we used it. VC, we don't know if we used it to pay down this debt or if we used it to buy a forklift, or we don't know exactly which use it was for, but it was part of the overall pattern of using cash. Make sense?
I'm still trying to wrap my head around. You are right, it's counterintuitive.
It is counterintuitive, yeah.
It's not really vague, but I think cash actually fits in as net worth basically because basically net worth on the balance sheet is sort of the balancing figure on the liability side, net of all the liabilities and assets. And cash basically sort of plugs in because the moment you have cash increase, the net worth will reduce exactly the opposite.
If you want to think of it that way, that's fine. Yeah. But at the end of the day, you can, in your business, or some business you are helping, if you're an angel and you're helping an entrepreneur trying to figure out where his cash is going, he's probably being given a balance sheet and a P&L every month and no cash flow statement. That's what I always find. Nobody's preparing cash flow statements. So what you do is you pull out the balance sheet from 2 adjacent months and you just do this, right? How long will that take you to do?
About 5 minutes.
5 minutes, right? and you put them in the proper columns, make sure it balances at the bottom. If it doesn't balance, move cash to the other columns, figure out which one you got wrong, okay? Until it balances, then you have it right, and say, okay, now we know where the cash is going. So, where is the cash going? Why is Mr. Butler using so much cash? Anush.
I mean, you're going to do the set-offs, right? You're going to set off accounts receivable against accounts payable. You're going to set
Well,
notes payable against bank. Your net figure basically comes to you financed inventory 2/3 by the bank and 1/3 by your retained profit.
so there are some big uses of cash here, right? The biggest one is what? Is that a 196 or 146? I can't read it.
146
It's,
and
it's,
179.
it's a 146 and a 179. So the biggest use of cash is that inventory went up. And why did inventory go up, do you suppose? It's a cyclical business. We're coming into spring. Maybe we had to stock up. Mhm. And also, why else? Sales have gone up. You need more inventory if you're doing more sales, right? So is it reasonable that inventory should go up?
Depends. If it
You have to trend it. No? You have to
We gotta figure out if it went up the right amount, but it's reasonable that it went up. Is that fair? Okay, so that's the biggest use of cash. What about inventory? Oh, no, we said inventory. What about accounts receivable? They went up too, right?
The offsets you replenished well because your accounts payable have gone up reflectively almost the same figure. So your net financing for receivables versus payables.
So you're trying to compare this number with that one that I can't reach up there, right?
I don't think that's. I don't think that these are two independent things, right? These are vendors versus.
They are independent, but it's worthwhile thinking, can I get one to finance the other? It's a fair question that effectively Anuj is asking, right? If I could get my suppliers to finance my customers, that'd be nice. Yeah. Okay, so a lot of money is going to receivables and inventory. A little bit of money is going to a small amount of additional property, forklifts, whatever it is he bought. And there's a chunk of money over the 2-year period that went to pay back Mr. Stark, right? Okay.
But you see, you've taken short-term money, in sense notes payable to the bank, to fund long-term, to pay off Mr. Stark.
If you want to argue that, yes, you can. You can say, well, I wanted to pay off Mr. Stark, so I borrowed from the bank. I got the money from the bank, and I used it to pay Mr. Stark, and I used some more of it for inventory and payables as well, right? Or receivables as well.
The thing is that it is not so much of a business decision, it's his personal decision to kind of, put it on business. So he should have leveraged his personal property or personal assets to do that and should not be reflecting in the balance sheet. I think
You could argue that, but this is the asset he has, and that's how he was able to do it. And is it reasonable to think he should have wanted to get rid of Mr. Stark and buy the business and own it himself? Yeah. Yeah. Personal thing that's perfectly reasonable. Cash is this company really burning here? It's a profitable business, but if we look at the uses, what do they add up to? If we add up to the sort of changes in working capital that are independent of the financing sources, that's those top three numbers, right? The 146, 179, and 31. That adds up to 356,000 change in working capital. It's sort of being driven by just operating the business. Forget about whether the banks give it to us. And the sources are 17 and what, the 15, right? So the operating cash flow of this business is sort of the net between those. Question, Anuj?
Yeah, I just want to know, I mean, would it be fair to try to just, a quick calculation, what I was mentioning, you try to do the offsets as fast as possible to come to a quick conclusion to, as I see it, glaring it seems at least to me, the inventory is where the money is going, and half of it's being financed by retained profit, and half of it's being financed by notes payable. So So you're taking a judgment call and saying, okay, half the business's growth is self-financed, the other half is financed by notes payable, and therefore is the business sustainable in terms of growth, and that's how much money will suck in for every additional rupee. That be a
That's a reasonable thing to say. Yeah, exactly. Yeah. Okay? So even though this is a profitable business, it's quite clear that it's burning cash, right? There are more uses arising from the operation of the business than there are sources arising from the operation of the business. So a second question we might want to ask is, well, okay, inventories and receivables and things have gone up. Have they gone up by appropriate amounts? Yeah? So to do that, we could look at the cash days of the working capital accounts. So take a look at these pages, and I'll pull them up on the screen. Thank you. There are three key working capital accounts in this particular business, where short-term money varies according to how quickly the business grows and how well it's managed. They are accounts receivable, inventory, and accounts payable, right? So what I want to do is know how many days worth of each of those things I have. So the question you might ask is, John, how did you calculate those days, right? And the way I did it is I went to the profit and loss statement and I looked at the top line sales number in 1990 and I divided it by 365 days. And I said, how much sales am I doing a day? And I did the same thing for the cost of goods sold line and said, how much am I doing in cost of goods per day? And then I take those figures and divide them into the balances. And so if we look at accounts receivable, taking 1988 sales and dividing that into the 171, you get 37 days. Does anybody want to kind of look at that number and make sure that I'm right here? $88 sales divided by 365, then we take that daily rate and divide it into the receivables.
Yeah, that's 37.
Does that work? Okay. Crucially, I got it right? Yeah? Good, I can still do maths. Okay. Now, if we do the same thing in 89, we divide 89 sales by 365 and we get 40 days. And if we do it for 1990 and do the same thing, we get 43 days. And if we want to do the first quarter, we can divide the first quarter's sales by 91 days. Does that make sense? First quarter divided by 91, and we can do it for that data too. So what's happening with the days of accounts receivable? It's going up, right? Okay. Is that good news or is that bad news that it's going up? We're letting our customers pay us more slowly, right? Yeah. How much is that costing us in cash? Suppose that 43 figure here we're taken back to 37. If Mr. Butler did a better job managing those receivables. If we could trim that back to 37, would that free up some cash?
A lot.
How much? Well, let's figure out how much cash it would free up. if that figure weren't 43 days, see the 317? I can't quite reach. That figure up there, if that figure became 37 days, what would its value be? We would take 6/43. 6/43 we would take away from 317, which would get us to, we take 317, multiply it by 6, and divide it by 43. And that number is, what did you say? Somebody ran that. 44. So that accounts for 44,000 of the 146,000 increase we have. Right? Okay, now we can do the same thing with inventory. What's happened with inventory? Went from 71 days to 83 days to 88 days. If we could pull inventory back to that old 7-day level, what would that be? It would be 7 out of 78, which is around 10%, not quite 10%. Well, let's calculate it. We take our daily rate of cost of goods, not our daily rate of sales. You don't use the sales. Use the cost of goods.
Total cost of goods.
That's 78.
78? Yeah.
1950. 1950 by 365.
Okay. So far my math is still good, right? Yeah? Are we all agreement? The 78 is good number? Now, if we could trim that 78 back to 71, we'd be taking 7 days out of that, which is about 9%, which ought to be another, what, 37,000? Okay. So if we add up the 44 and the 37, that's 81,000 of our increase between those two categories is due to the days getting a little out of hand, right? What's the rest of it due to? No, the increase in receivables and inventory. We've accounted for some of the increase. The balance of the increase is caused by what? Increase in sales. Holding the days same, but making the sales level bigger. Inventory has to be bigger. Okay, now there's a very important number here on this chart that you see I've written in here. It's the length of the operating cash cycle. That's what OCC stands for, operating cash cycle. And what I mean by the operating cash cycle is the length of time it takes from the day you receive a piece of lumber until you sell it and then get paid for it. Does that make sense? So every time I buy lumber, I need to use up cash until my customer pays me having bought that lumber, right? So how many days does that run? Well, in this year, it's 37 days. Well, first of all, if I buy the lumber, it stays in my inventory in average how many days? If I buy a piece of lumber, it sits there for 71 days, right? Then somebody buys it, and when do they pay me? 37 more days. So the length of my operating cash cycle is 108 days. Do you follow that? In this year, the length of my cash cycle was 123. It's the sum of those two. And in this year, it was 121, the sum of 43 and 78. Okay? But fortunately, my suppliers are financing a part of that, right? What part are they financing? Well, we go down to notes payable, and we take the 124, and what do we divide that by? What daily rate? daily rate of cost of goods sold, because that's what we're paying for here, right? Cost of goods. Okay? So we take our daily rate figure for cost of goods, divide it into the payables balances, and we get 37, 49, 48. Right? So that has gone up by a total over the 2-year period. Well, it was on the other sheet. But that is financing a part of this. Okay. So how well is Mr. Butler managing the balance sheet in his business? Would you give him good marks or bad marks? Let's ask Mr. Butler himself. Are you doing a good job at managing your balance sheet or a not good job? What do you think?
You're doing a reasonable job. I wouldn't say it's great, because you should be trying to push down holding inventory levels the same. But
Okay.
it's a growing business. You need to if you're getting more customers in, they will ask for stronger return to trade. I don't understand why he's holding so much inventory. As in, he should be able to push down inventory because it's a commodity that doesn't require a long holding period.
So how would we know if, 80 days or so is a good number for inventory in a business like his?
First thing you do is you do comparables. You see what the rest of the industry is doing, and to know, are you doing as well as them, and is that the industry level or not?
Yep.
And then that's the benchmark.
So there are two kind of comparisons we can do. We can compare with our own history, which we have here, but you would also want to compare with data from other companies in the same industry. We don't have that data here, so we don't know whether Mr. Butler is better or worse than others in his industry. But it appears that, based on at least his history, you need something like 80 days, 70 or 80 days worth of inventory to have enough to serve the customers, but not so much, that you're tying up too much cash.
So I disagree with Anuj. I think that he is losing sight of his working capital. He's really just going after trying to get volume, and therefore he is going to land up in a mess because his cycle is just increasing. So from 108 days to 123 days, now actually maybe it's seasonal, but it's gone to 139 days. And he's now actually the real cash crunch.
Okay? So you have a little more concern about those numbers than Anuj does. Yeah, fair enough.
I think the other thing is, this business is, primarily a commodity, lumber by nature. It's basically a price that fluctuates very violently. And the issue is that, all he's doing is just adding a bit of value, which really isn't, because all he's doing is molding it into different forms, right? Molding and selling it, right?
He's a trader. He buys and he sells.
So if you see his purchase prices and you see his sales price, they're absolutely moving in tandem. So it's very clearly evident that he doesn't have any pricing power, so to say, he's basically adding a margin over and above.
So
So the problem is that if he grows in business, which is in terms of figure, he's not able to increase his margin, so to say, because it's a problem.
And use all the cash discount, because the cost of borrowing is 10.5, the cost of cash discount 24% per annum. So you're making a clean spread of 13% on your cost of goods purchased, right?
So Anuj has said something very important. He said we can borrow at what effective price? 10.5. And what is our cash discount costing us? 2% for how many days? It's the difference between 10 and what we're normally taking. What's our normal? So it's 30 days. So 12 times 2, 24%. So the bank debt looks cheaper. You're saying you should take the bank debt.
Because you're basically financing, you're getting 13% in the buffer.
So your business will be more profitable, if that's your criterion, by taking the cash discounts, right? But what will that also require?
Them to cough up.
Somebody's going to have to come up with more cash to enable you to do that. The 638. And what if the banker says no?
I'm just saying, academically,
Yeah, but academically,
push it up.
we'd rather be concerned what happens in the real world, right?
Sure.
So
Okay.
compromise could be take as much debt as possible from the banker. So if he's giving you 450,
Okay.
take that debt and take the cash discount. That's a
Take
in-between-
some of the cash
in between.
discounts.
That's a best
But
of both
could you
worlds.
do something else? Maybe this will work. Let's see if we can do it this way. I don't know. What I'm about to do with you is the most difficult thing we're going to do this week. This is very tricky. Okay? So you're going to want to stop me and say, wait a second, will you go back and do that again? This is really tricky. What I'm going to try and figure out here is a solution to Anuj's problem. I want to know how fast could Mr. Butler grow his business without having to ask the banker for more money. Okay? Because we'd like to do that. We don't want to sell equity. Nice idea, but we just bought our partner out. We don't want to go back to that. We'd like to grow fast because there's 3.6 million that the market is telling us we can get, but it's looking like it's. I'm going to make some assumptions. I'm going to assume that accounts receivable days are 40. Is that a reasonable assumption given our history? And inventory at 80? Okay. How long is our operating cash cycle? It's the sum of those two. From the day we get a piece of lumber till the day we get paid, having sold that piece of lumber, 120 days, right? That turns out to be a really important number. But our vendors are financing part of that period, right? How much are they financing? 48 days worth. Because that's the average payables days we've had in the past. Now, Anuj, you suggested we add another 15 to that. How happy are vendors when they go from 48 to 63? Not happy. So you do it if you can get away with it, but you might not be able to get away with it. All right? Now, what does that mean? That means cost of sales, that lumber we buy, has to be financed for how long net? 72 days. It's the length of the whole cycle minus the part that our vendors are covering for us, right? So we're going to need cash to cover our cost of goods for 72 days out of every cycle, and we're going to need cash to cover our operating expenses for 60 days out of every cycle. Now I need to explain this to you. What are operating expenses? Light, wages, rent, all that stuff. When does that occur in the operating cycle, that 120-day cycle? It kind of happens at different times, right? Maybe you pay your wages every 2 weeks, maybe utilities are once a month, who knows? So I'm going to make an assumption that they are paid evenly through the length of the cycle, whatever the length of the cycle is. Sort of spread like peanut butter. Okay? Mathematically, that is the same as if I say I'm going to pay them all on day 60. Think about what I just said. Mathematically, is it the same if I pay a little bit every day over 120 days, or I pay it all on the middle day?
Why is it 100? Oh, 100, why 120
120
days?
is your operating cash cycle, right? That's the basis for.
That's a separate cycle.
It is a separate cycle.
One is a receivables and a working capital cycle.
Correct.
The other is expenses which are every month or every 2 weeks or whatever you said.
You're correct.
So they're different.
They are different, but I think it's a fair, they are independent of one another.
Independent, and they're
Yep.
different. One is, you're talking about a large chunk is on your working capital. This is much smaller. It's only based on 25%
Correct.
higher operating cost.
Correct, and they are independent. So I don't know exactly where they're going to fall in the cycle, and depending on how long the cycle really is, they might fall differently. But I think it's a fair assumption to say they would be paid evenly over the cycle. Do you think that's a fair assumption?
Isn't it easier to say that your 3.6 million is your sales, 25% is your operating margin expenses. So you take 1/4 of that, so 900,000 is what you need to do every year. And then you just divide it by 12, and that will give you in terms of the amount of money you need every month.
Mhm.
And then you just
If I wanted to know the amount of money I need every month, that would be easier. But what I want to know is how much money do I need every cycle?
You're linking the length of now.
I'm going to link it to the
Operating cycle.
to the length of the cycle, and you'll see in a minute why I'm doing that. Okay? So if you buy my assumption that it's reasonable to think it's uniform over the cycle, and if you buy my assumption that paying it all in the middle day is the same as paying it a little bit every day, then the maths are going to work. Okay? So we've got a cycle length of...
But it's still
No,
60 days of
but
what?
exactly, that's the point. So maybe all, I think we both hit on it at the same time.
Okay.
But see, the duration of this expense is 30 days. That does not change.
The duration of what expense?
The operating expense, you have to, sir, I'll take the Indian example. You pay salaries every 30 days. You pay
Right.
rent every 30 days.
Right. Right.
That duration is independent. Again, the cycle
Agreed.
itself is independent of the,
I agree.
right?
I agree.
And that's not optional. This is not something that you can leverage and say, you know, I'll defer this.
I agree.
So how is the operating expense cycle 60 days?
It isn't. The operating, I'm not saying there's an operating cycle that's 60 days. I'm saying there's an operating cycle that's 120 days. But it so happens that I also have other bills to pay during those 120 days, as you just pointed out, rent, wages, and all that stuff. And I'm saying on average, that stuff is spread like peanut butter across the cycle. That might not be a perfect assumption, but it's probably pretty close. On average. Okay?
But it is, just to repeat, it is off to the 25%. It is
It's the 25%.
25%. So the number will be different. Days now, you just made it simpler.
Yeah.
Number of days, but it's number of days of 25.
Yeah.
And not number of days of 75.
Yeah.
Because 72 is of 75%.
You got it. Okay. Let's make sure we're all in the boat here together. So if anybody's lost, wait a second, I'm lost. Who's lost here? You're lost, Umesh. Okay, how did we lose you?
I'm not being able to connect the operating expenses with the head that we taken out here, that's accounts receivable and inventory, because he has the operating expenses would be other heads.
Yes. They're completely unrelated, I agree. But I do have to pay them. So if I have an OCC, an operating cost cycle of 120 days, it just so happens that during that cycle, I'm going to also have to pay rent, pay my people, pay the light bills, and so on. Do we agree? Do you think it's a fair assumption that I say, on average, those will fall evenly across those 120 days? Okay? I'm asking you to accept that as an assumption. It may not be a perfect assumption, but it's probably pretty close.
Okay, I would want to see how you're going to use this assumption.
Okay. We'll get there,
Sure.
but I want you to see what I've done. So I've made that assumption. You can decide whether you accept the assumption later, but that's the assumption I'm making.
This question on the denominator, then divide by 2. 120, if I'm not correct, I mean, if I'm not mistaken, is the same as the OCC that we calculated about 120.
This 120 is this 120. That's right.
So we're not doing operating expenses as a percentage of sales and arriving at number of days.
No. No.
So we're assuming that the operating expenses also follows the same cycle as
No.
the other part of the business.
No, I'm just saying there happen to be expenses during those 120 days on whatever cycle they are, and that it's reasonable to think if I paid a part of it every day equally, it's reasonable to think that that might be approximately true. And if you think that's approximately true, mathematically, that's the same thing as paying the whole bill on the middle day in the cycle instead of paying a little bit every day. Okay? Okay. So, Anuj, yep.
Out of left center here.
Yep.
Do you think it's worth we trying to see if we can come up with an answer? Because I mean, back of the envelope calculation of what we think is the self-financing? Because you're obviously going to show us, but do you think it's worthwhile we try and attempt? I mean, I have some ideas of, how would you calculate? Because obviously there's an academic way to do this, and then there's the sort of back of the envelope. Let's see, as a businessman, how we want to calculate. So, do you think it's worth doing that, or we should just go through the?
I think we should go through this.
Okay.
Yeah. Okay, so let's try and do that. So what I'm going to do now is I'm going to prepare an income statement to show what happens during one cycle. Because during these 120 days, we're doing some business, right?
Yeah.
Okay? So I'm going to do an income statement based on $1 of business. So what's the cost of goods sold going to be? 72 cents. We already decided that based on our history, right? What are all the other costs, including interest, taxes, everything? Well, we've said historically our profit in cash terms was 1.7% based on our history. So all those other costs ended up, including, interest and tax, 26.3%. That's, the tax plus the operating expense. Okay, so now here's my crucial question. How much cash do we need to get through one cycle that lasts 120 days? That's the question I'm going to ask. Well, we need money to fund the cost of goods, right? So we need 72 cents. Do we need that money for the whole cycle? Or do we need all of that money? We don't, because our vendors are financing some of that money, right? So we don't need all of it. The vendors are going to finance 48 days of it. So we need 72 days worth out of the 120 days to fund our cost of goods sold, which is 43 cents to get through one cycle that lasts 120 days. Have I lost anybody there?
Fine.
You sure? Everybody fine? Okay, now.
Just going back, your operating and other expense at 26.3
Yep.
was including interest. Whatever you just assumed something.
I just took our history, our long-term history, saying we're averaging 1.7 cent profit after tax. Okay? You could have said 1.8 or 1.6, whatever you think is a good number. Okay? That's our history. All right? So I need to finance cost of goods sold, right? Because I'm going to have to pay those bills. So I need cash to do it. How much cash do I need? Well, I need 43 cents to fund that cycle. I also have to pay the other bills, right? As they occur during the cycle. And I already made an assumption that I'm going to pay them all sort of on the middle day of the cycle. So I don't need a whole cycle's worth of that money. I just need half of the cycle's worth of the money. Okay? And that portion of the P&L is 26 cents. So I need 13 cents for that to fund myself to go through a cycle. Do you follow? Okay, so how much money do I need to get through a cycle? 43 cents to fund cost of goods, 13 cents to fund operations. Total, I need 56. A profit at the end of that cycle, right? How much profit? 1.7 cents on $1 of sales. Right? Okay. What could we do with that 1.7 cents? We could reinvest it into the next cycle, and in the next cycle we could do a little more business than we did in this cycle, right? Because we could now buy some more cost of goods, pay some more wages, and all of that. So let's see what happens if we do that. We take the 1.7 cents that we're going to earn by investing the 56 cents from up there. Okay, see where these two numbers come from? There and there. We're going to earn 3% by going through one cycle. How many cycles are there in a year? Just over 3. If we earn 3% in one cycle, how much can we earn in a year? 9% extra cash to invest in growing our business. So we can grow the business at 9% a year
Without having to borrow anymore.
without having to ask anybody for any money. Our internal cash will let us grow at 9%. But our actual growth rate was 18 and 33, and we're projecting even higher. Okay? So clearly, our business does not let us grow at the rate we're growing, which is why we have to go to the bank. Okay? So the question is, what self-financeable growth rate. Okay? Now, so what could we do about it? Well, one thing we could do about it is manage how long we're tying up cash and change our inventory days and our receivables days from 40 and 80 to 36 and 70. Is it reasonable to think Mr. Butler could do either of those things? Why?
And he did better, tighter.
First, he's done something similar in the past.
He's already been there, right?
Been there.
So he used to have receivables as good as,
37.
was it 37?
37.
Yes.
Okay, so 36 may be achievable. And inventory, how good did he have? Okay, so maybe he could get to 70. Okay, now what would it involve to do so? Send out the invoices on time, follow up, make sure people pay you, watch your purchases more carefully, don't buy too much, all that stuff, right?
Intuitively, if he could have done all that, he would have done it, right? The fact is,
Well-
maybe he's trying to get more business by therefore giving people some slightly longer credit than the others, and, you know.
That's possible, or the other possibility is he's just a little sloppy, right? Most businesses are a little sloppy. Okay? So if we can do those things, what happens to our OCC? It's shorter now, right? 106 days. My payables number I didn't change because I'm nervous about stretching payables by 15 more days. So I kept it the same. So how long do I have to finance cost of goods? 106 minus 48 equals 58 days. And how long do I have to finance operating expenses? The cycle is now shorter, right? So I have to finance them for half of the cycle, which is 53 days. All right? Now, we just do the same calculations we did before. Have I changed anything in the income statement by tightening that up? Not at all, okay? So that's exactly the same. So what happens here? I need the 72 cents up there to fund my cost of sales, but I only need it for 58 out of the 106 days in the cycle because my vendors are financing the other 48 days. So I need 39 cents. I need my operating money of 26 cents for half a cycle, 13 cents. Notice that number hasn't changed. It's a different calculation, but it results in the same number, right? Because it's always half a cycle, no matter what the cycle is. Since it's always 26 cents, it'll always be 13 cents. So now I need 52 cents to get around a cycle. I'm still going to earn 1.7 cents as I go through the cycle. So what happens? Now when I go through the cycle one time, I have 3.2% extra cash generated. There are now 3.5 cycles in a year instead of 3. So at what rate can I grow? 11%. Is it good enough for Mr. Butler? Better, but not much better.
But just one thing, you know,
Yeah.
this exercise, right? Again, he's brought down the inventory and the collection period, right?
Mhm.
Is it? I mean, I'm still not able to come to grips. How would that really translate also in, you know, my reduction of the operating expenses cycle? Because those are still going to be paid out in the same schedule like they're supposed to be, right? I mean, why would that come down to 106 from 120 days earlier?
It's not an expense cycle that I'm changing. I'm calculating everything in terms of the operating costs cycle length.
Right.
There is no cycle for the operating expenses. They're all just paid randomly through the year.
Then I think your mathematical assumption, you have to keep repeating that, right? Because it's
Yeah.
not intuitive. Because it was a mathematical assumption, you are just carrying that assumption forward, and again you are saying that it's the mathematical assumption carries forward.
Yeah.
Right? We are stuck in a rut because we say salaries are due end of month. So
Okay.
it's very difficult to reconcile.
Yeah. But you know, salaries might be due the end of the month, rent might be due on the 10th.
Mathematically, you are right. You're absolutely
All that stuff. You know, I buy some more supplies, you know, a new crate of light bulbs. That happens to come in on the 23rd. All those things, just throughout the whole year, forget about cycle. They're just spread evenly. That's the assumption I'm making. And because they're spread evenly over the year, I can spread them evenly over a cycle of any length.
Why is spreading it evenly over the year? The thing is, why should 106 days actually come up 120? So evenly, like, the divide by 2 is fine with me, absolutely. So just because I got disciplined in terms of, better collections, better inventory management.
Yeah.
How would that impact the other inventory costs?
Number, 13.2 cents.
I just got confused.
What was it on the other page? It was also
That is,
13 per...
because you're assuming both are coming down.
Yeah, so they come down by the same amount, so I haven't really changed anything. Okay? Okay, so we get down here, we can grow at 11%. That's not good enough. Okay? So what else could we do? Somebody said, well, let's improve profitability a little bit. Suppose we could improve profitability by 1 percentage point, go from 1.7 to 2.7. Is that easy?
No, that's not easy.
Not easy.
Not easy.
Fair enough, it's not easy, but suppose we could do it. Okay? What's going to happen here now? Look what I've done with these assumptions. Have I changed them? No, I kept those improvements, and I said we're going to add the improvement in profitability. So the P&L now looks different when we go through a cycle, right? We have an extra penny of earnings when we go through a cycle.
No, but that assumption itself is dangerous. See, because you are jumping profitability
By a lot.
I mean, what is
Yeah.
the basis for that? What is the basis for that assumption?
Okay. What would be the basis? If Mr. Butler said, I have a problem, I want to grow, the bank won't give me the money, I can tighten my payables, we've just done that, it helps me a little, does it help me enough? No. Okay, what else can I do? I could improve profitability. Okay, how?
What is the assumption?
How?
How? Exactly.
Yeah? So, no, no, I've never made that. So how could I do that? Sridhar? Increase some prices.
But he is the person who is doing the similar work. He doesn't have pricing power. So, again,
If it's a lumber store, can he increase some prices?
Some prices. A few products that are really selling.
overall, you want your profit to increase, profitability to increase by 50%, right?
If you increase
Across the board.
if you increase it 3%, no, you take some products which are fast selling and you improve it by 2% in those.
Yeah.
So overall,
I'm just saying, what if Mr. Butler could do this? I didn't say he could do
This
it.
product brings in pricing power. He cuts it down his salary.
I'm asking, could he do it by buying smarter, by squeezing his vendors, by finding some items that are not price sensitive and boosting their price? I don't know if he could do it, but if he could do it, I'd like to know what happens, okay? So let's see what happens. Here's what happens. Cost of sales, now we need, see that? We need 71 cents, not 72. And we still need it for 58 of 106 days, so that's this. And notice what happens here, still the same number. Okay, we need 52 cents to get through a cycle. We generate 2.7 cents. That gives us a 5% extra cash as we go through a cycle rather than the 3% or so we were at. There's still 3.5 cycles in a year. Now we can grow at 18%. We're getting there. he thinks there's business in the marketplace to do 3.6 million, which is a growth rate of 33. Okay? So if he raises some prices, that will probably bring down his sales, right? Some customers will go elsewhere. So he maybe can't get the 3.6 million, but maybe he could get, who knows, 3 million, whatever. Okay, now, one more thing. Suppose he could do this by 2 points. And VC, you'd say, Mr. Butler,
You just lost him.
Mr. Butler, you're dreaming. Your cash profit would go to 3.7 cents, right? And what would happen? Here we are.
It's actually not correct because I don't mean to split hairs, but the 2 percentage points are not going to go straight there. There's also tax on it. Anyway, sorry.
Yeah, fair enough. Okay. What happens here? Now we earn 7% in the cycle, still 3.5 cycles. Now we can grow at 25%. Okay. Now, one more thing here. Suppose he took the cash discounts, because we've been wondering about taking cash discounts, right? Suppose he took them. Okay? What happens here? We're at 106 days on the cycle, but the payables have gone from, what was this number before? 48? Down to 10. So for cost of goods, instead of tying up cost of goods around, what was it, 72 days or something? Now we have to tie up money for cost of goods for 96 days. So let's see what's going to happen here. Still operating expenses half a cycle. Okay. Cash profit, I'm going to keep my same assumptions, a 2% improvement. Plus, 2% improvement plus the improvement in cost of sales, because I took cash discounts, which improved this by 2% of the old figure there. 2% of 72 is 1.4. Took out the 1.4. This was 3.7. It's now up to 5.1. See that? Okay? So if we make that kind of profit, here's what happens in a cash cycle. We now generate cost of sales.
Minus 2, you took 70, and then minus 1.4, which is the cash discount, and then you came to 68.6.
Thank you. That's what I did. 70 minus 1.4. Yep. Clear?
Just look at the previous line.
Okay.
It's 70.
Let's go back to what it was.
70, which is what DC was going home about.
Here's what cost of sales was before. This is what it was before. If I take 2% cash discounts on this, it'll come down 1.4. And what will that do to my cash profit? It will add 1.4. So my cash profit goes from this old 3.7, you see it there, to now a new figure of 5.1. Follow? And what happens to my cash cycle? I need 62 cents for cost of sales. I now need a lot more money to fund my cost of goods sold because my vendors aren't funding it. Still the same for operations. Need 75 cents, but I generate more profit. So profit is good, right? But I look at my SFG calculation, and the annual rate is 23. Which direction did it go?
No.
Down. Compared to the previous page, it went down. We were at 24.7 on the previous page, and now we're at 23.3. Right? So taking cash discounts in a fast-growing business might slow down your growth, your ability to finance your own growth, depending on what are your days of payables, receivables, and all those things. So the advice our accounting professors always gave us that said, always take cash discounts, is fine for a pretty stable business, but for a fast-growing business like this one, it might be bad advice, right? Because we can actually grow faster by not taking them and investing that money in our cash cycle to grow the business a little. First of all, if you guys are going to train high net worths to help their angel investees, one of the things they're going to help them with is to pound into their thick skulls that it is not about profit, it's about cash, right? And that will be very difficult to do.
Question is, I think most of people who have been looking at profit and loss account more than cash would actually need to learn from HNIs because they may be managing more cash. That's how they are HNIs.
The HNIs may get this more readily than the entrepreneurs who are earlier in their learning cycle. That's right. Yeah.
Top line is sanity. Top line
Yeah.
is vanity. Bottom line is sanity, and cash flow is reality.
Yeah, that's right. Exactly. Exactly.
Possibly that's very true
But-
in cases these.
And maybe the way they got to be HNIs is they understood that. Right? But the rest of the world doesn't understand that. And in business schools, all my MBA students, they're really good with a P&L, clueless with a balance sheet, completely clueless. People out of big companies, really good with a P&L, because how do they get incentivized? On the P&L. They're clueless about balance sheet. Oh, that's the treasurer's job. I don't have to worry about that.
In fact, not P&L, most is only top line,
Maybe it's even top line, yeah.
which is the worst.
Yeah, it's even worse, okay? So I think it's fair to say that finding cash for growth, if you're an HNI investing in a company you want to grow really fast, finding cash to fund that is a really crucial challenge, right? And going to a bank is one way to get it, and it's cheaper money than your angel money, so it's a good thing to do. But a better way to do it, maybe, is to manage your working capital characteristics, as we've just seen. Okay, now, there's this myth about taking cash discounts, and as we've just seen, it may be a myth. It might not be a myth for some company, depending on how many days and what's the margin and all that. So you have to run the numbers to know. Okay, now, if there's a strategic window that opens and you have a chance to go grab some business, it might be really helpful to say, well, I've been taking cash discounts, but actually, now's the time not to, and I'm going to put that cash to work to grow my receivables and my inventory so I can go grab the new business instead of taking those discounts. Now, to the question that was just raised. Should you offer cash discounts to get new business? Because this works both ways, right? We're selling stuff. Should we be giving cash discounts? What do you think?
The margins go to heaven.
If you really need to, because if the business is anyway growing, why would you want to really extend those cash discounts?
Well, some people do so because it's easier to get new business when you do, right?
Yeah, but we've already assumed that the business is anyway growing, because in this scenario also the business
Well, we can assume, but in the real world, we don't assume. You know, we have to live with the consequences, right? And our sales force often says, well, you know, just let me give them a discount, right? Because I can bring in some business. It's easier that way. But the implications are it cuts into margin, and we now know if our margin every time we go around the cycle falls, what else falls? The ability to self-finance our growth, right? It lengthens the cash cycle, it cuts into margins, okay? So giving cash discounts as a way to grow your business faster is fundamentally a pretty bad idea.
of financing your business,
Mhm.
okay, that is just, say for example in this context, is just 10.5%. Okay?
Yeah.
While what
Well, another way to think about that cash, instead of giving those cash discounts, maybe there's something else you should do with that cash. Invest it in R&D or who knows what, okay? A better way is raise your margins. Now, how do you raise margins? You can strengthen your gross margin mix. You don't have to raise all your prices, but there are probably some things that every company sells, you know, it could charge more for them and it would not affect demand. Probably some things in the mix you could do that way. You could buy better, you could control operating costs, but these across-the-board price increases, they make no sense, right? So don't do that.
In fact, you may want to do a combination. You may
All
give
of those
discount in
things.
some and increase some.
Lots of stuff, exactly. So why is it better? It improves profitability. It improves cash flow. It may slow down your growth a little bit, but it may let you do that without taking on more debt or having to dilute your ownership by going and raising more equity capital, right? The drawback, though, is if you don't take advantage of the demand that's in the marketplace, somebody else may take advantage of that. So these are not simple, easy questions. Now, to manage a growing business, there's some implications around building your sales force, around pricing decisions, and around how you get people on board. So if you think about it, salaried people doing your selling increase fixed cost, right? What does that do? Takes that operating cost number and makes it bigger, so you need a little more money tied up over the cycle. And what does that do to your self-financeable growth rate? Slows it down, right? Suppose you can outsource your sales function or pay commissions after the sale. That saves that cash for later, right? So it helps conserve cash, speed up your SFG. What should you do? Well, this isn't the only consideration. There are other reasons why you want Salesforce inside or outside, but sometimes the cash side of this is overlooked. Pricing decisions. It's easy to price on cost plus. Lots of companies do it, but it's not very smart to do that, right? Because some products can get a higher margin. So razors and razor blades, where's the money made? All on the blades, right? Printers and ink cartridges, where's the money made? Have you ever?
In India, you have a refilling ecosystem which has crashed those prices.
Yeah.
Only for not for the printers.
Printer is चने के बाबू का यार कुछ नहीं है 4,000 में ले लो
It's again the same like car and car servicing. Money is in the servicing. Oh, I did not know. And the spare parts.
For the dealer.
or the
Yeah.
dealer
For the dealer.
or the dealer.
Yeah. Have you ever calculated the price per ounce that you pay for the ink in those little
3x of
cartridges?
gold. This is a declared number. 3x of gold.
3 times gold. Yeah, it's crazy.
3 times gold.
3 times the price of gold per ounce. Yeah, it's crazy. Okay. Now, the other thing is some customers may be willing to pay more than others for different versions. Lawnmowers, toasters, you know, you just change some little feature and you charge more. I've been watching the price of liquor in duty-free stores. Have you ever studied this? Look at the different kinds. So like Johnny Walker Scotch, they have red label, black label, all these things. they've now created some new labels that they sell. Double black or whatever. Is the whiskey in there actually any different? I don't know, but I think they're just creating another price point that they can give to the duty-free guys, so the duty-free guys can jack it up, then reduce it, and think you're getting a great deal, right? So there's a lot of playing around with pricing.
I think just one more point, there is another aspect to pricing, which is value-based pricing.
Yes, exactly. Yeah. So don't do cost-based, do value-based. Yeah, get the price you can. There are implications to motivate your team, right? Is it in everybody's interest to manage cash for growth? Everybody inside this company whose high net worth is helping to get this thing done? People like growth, right? New jobs, higher pay, all that kind of stuff. So I think every company should calculate a common size analysis and a cash days analysis and show it to all the key people every month. Now in India, people are scared to share data, especially in family businesses, right? But is there any reason why we couldn't do a common size analysis and a cash day analysis and not share that? I don't think there's any reason. And then everybody can help us do it. And, you know, this notion of days is pretty easy for everybody to understand. Okay, most important thing, if you're at cash flow break even or better, that's the best kind of independence an entrepreneur can ever get, right? Because the banker has nothing to hold over his head. The equity investor has nothing to hold over his head. So it really is, you know, freedom. And that's really important. Okay. So if you're going to grow your business, it's not about profits. It's about cash. And managing cash is everybody's job in the business. It's not the CFO's job. The CFO merely reports the outcome of what everybody else does, right? Okay. So those of you who are in a business, I want to leave you with a challenge. I suggest you go run these analyses, go through the hidden cash logic, and see how much cash you could free up in your business. By just going through and saying, oh yeah, my receivables days have slipped a little bit. My inventory is getting a little high. If I get that back under control, I can free up who knows how much money. I delivered this case to a bunch of YPOers a couple of years ago, and I got an email 6 weeks after the course from one of the guys. He said, I just want to let you know, I went back and did a hidden cash analysis, and I freed up $2 million that I've taken out of the business. It has had no effect on my P&L, but I now have $2 million that I'm deciding what I'm going to do with. Thanks for the class. I said, thanks. What cut do I go? But really, there's money there in almost every business because these things just aren't managed quite tightly enough. So anyway, there we are. So that's tough stuff. I mean, that's pretty tricky stuff, right? But if you can get your heads around that and do it with, you know, the high net worths that you teach to be angels, and if they can then do this with their investee companies, it can really make a difference in how those companies grow.
One question now.
Yeah.
I've understood the entire thing that you have done.
Good.
However, I have one question which some of us ask. Operating expenses, which you have taken it as a divided by 2. Now, a 60-day cycle. I think, what if I do it like I want a 30-day cycle instead of a 60-day cycle? Would the answers be comparable?
It would make no difference.
It would make no difference.
No difference at all.
So it does not matter what that
If I pay my rent every 2 weeks instead of every month,
is, just the same amount. just
yeah,
in small proportions.
yeah, right, exactly. If you can cut your rent by doing so,
Then it's a different.
then fine. But
You can run another
if,
iteration.
yeah, right, yeah. Do you have any inventory?
Capital cycle.
None to speak of?
Yes, sir.
If you calculate an SFG for a business like that, what is it? It's infinite.
Except you have very
I mean,
high
your
operating
inventory
costs.
in that sense is the
You have very high operating costs.
Yes, but
Your fixed costs of those guys.
you'll have them, but even so, because you're getting cash on the day you perform the service and your margins are good enough, you'll have an infinite SFG. So services businesses are wonderful from a growth perspective.
But when you say infinite here, right, for a barber shop, right?
Mhm.
It leaves more space, right? No, but that's a function of capacity. That's a capital. But the moment you take up space, right, you have an interest cost coming up, right?
I'm not saying take more space, open one more barber shop.
It's like it's the Starbucks model, no?
Yeah.
Once you're making an X amount of money on a certain square footage, you can replicate the model 100 times over.
Doesn't have to be franchised, but it's a multi-unit model, yeah. So if you're in a service business, this is very attractive. Okay, so that's the hardest set of concepts to get around, I think, mentally, that we're going to do in our 3 days. But I think they can have profound impact on a young company that's trying to grow really fast. So I think we should wrap this up. What time is it? 12:30. I think that means it's lunchtime, huh? Yeah? Is lunch ready, guys? Yeah? So should we have lunch? And what time do you want to start? We're officially supposed to start it. And it's just a simple way to how to calculate the cash days for your working capital accounts. Not rocket science, but to give one or the other of these articles to an investee company and say, are you doing this? Run the numbers and let's talk about them and what can we do? They're simple tools, but they can, I think, potentially be quite helpful to you. So as those of you who are going to be training this material, think about how you might do that. There are basically two ways to do it. One way is you give them the stuff beforehand, you ask them to read it, and then you meet and do the training. But it's really hard to get people to prepare in advance, right, and read anything in advance. So I tend not to do that, right? Because even if I ask them, I know they won't do it, right? So it's better not to ask than to ask and not have them do it. So the other way is teach the stuff and say, now, by the way, here's a couple of articles that if you want to now read this to really make sure you have it nailed down, here they are, okay? So we're providing all of this stuff to you. It's on your CDs, and you can use it. And anything with my name on it, any PowerPoints or anything like that, you just change my name to your name. That's all you have to do. Okay? So observed about the style with which we've done these three half-day questions, these three half-day cases so far. What's it been like?
You ask a lot of questions and you wait for discussion.
Precisely what you just did.
Exactly what I just did, right? I didn't just say, let me tell you what I've done these 3 days. What did I do? I asked a question, what have I done these 3 days? And somebody will have observed, yeah? So in my view, good teaching isn't telling you everything I know about whatever the topic is, or in your case, you telling everybody what you know. I think it's much more interesting, especially teaching adults who actually have meaningful world experience, right? Much more interesting to them to draw that out. And one of the best parts of it is that I get to learn when I do that, right? I've been asking questions of people in groups in India since 2007. Do you think I've learned a few things about business in India? Yeah. Would I have learned the same things if I stood up here in front and lectured? Not a chance, right? Because when does the learning happen? When you listen, right? I had a very wise professor when I did my PhD. He said, I used to think learning was going on when my lips were moving. He said, no, I've learned it's the other way around. Learning is going on when their lips are moving because it forces them to think about what do they want to say. So relating that to teaching guides, which is the question you asked, a teaching guide is merely a series of questions that I want to ask to bring out the use of the tools that I'm trying to teach. And ideally, most of the learning will come out of everybody's mouths instead of mine. But if I have a guide, at least I have sort of a plan for what I want to hit. And do I follow the guide exactly? No, because I can't predict exactly where this conversation will go. But at least I have a plan for approximately where it should go so that I can make sure I don't miss major things. But occasionally, if there's a really interesting discussion that goes down a certain path, I might just delete some little section of the plan discussion because actually the one that happened was really useful and it's okay.
Just on the same topic,
Yeah.
can we modify this content to better suit, let's say, for example, topical needs?
What do you mean, can we?
Should we? Must we?
He's changing the question every second.
He did it.
Especially the numbers.
He did it again, didn't he?
Especially the numbers, I think it's much more easier to convert it into rupees and up to them.
Yeah, probably. Yeah. So the Actimed case actually is a converted case from an English case with pounds. And Artie and I did this, how long ago now? Artie, 2 years ago or something like that? Because we wanted to have an Indian case. It would take, and you can say, well, that's John's outline. Fine. But, you know, there's this other thing that I know about that's relevant to this topic. So I'm going to put in a little section of that I could use this case to bring out. So yeah, you can and indeed should change all this stuff to fit you. And in fact, in the entrepreneurial finance course at London Business School, which is the course I teach most of there, we offer 8 different sections of it during the year to accommodate all the demand there is for the course. And so we have 4 faculty that teach in various pairs. And the teaching notes that we hand out, like the stuff I've been giving you, differs slightly depending on who's teaching the case, right? Because we each just kind of have different ways of going about it. So absolutely, you should vary the material. Yeah. And you don't have to use this material. This is a set of tools you can use, but you don't have to do it. But it's a good start. Artie, our Indian, is that what I recall? I think so. Case. And the major problem in writing cases is that most people want to tell the whole story. But a good teaching case isn't a whole story. What is it? It's half the story that stops at a moment in time where there's a decision to be made, and you chop off the story, and you make the student make that decision. And figuring out where's the point in time to stop it, what's an interesting decision issue that will enable you to teach something you want to teach. Like Butler Lumber, it wasn't written to teach self-financeable growth, but it happens to work really well for that. This Maheny case was written to teach specifically about entrepreneurial teams. So if you know what you're trying to teach and can find a company with a decision issue they face that they faced a couple of years ago, because so you want to write a case on something that happened a few years ago, it also makes them much more open to letting you write the case. Companies are not likely to disclose their financials for the current year, right? But if it's 2 or 3 years ago, they may say, okay. And in the cases, we usually say we've disguised the financials. Do you think we really have?
No.
Maybe not. Maybe so. Depends on what the case protagonist wants us to do. Okay? So if you can find an interesting story that lets you teach what you want to teach and lets people apply tools, these are all tools you're being given, right? So find a case that lets you apply the tools, create it. NEN would be thrilled, has resources to support that activity. So.
We would also like any references you have of individuals
reads like a novel, yeah. And it has to be. So you have to have somebody who really writes well, but still understands business. And how do you find that person? But if we can,
A little bit of training is needed in that too, because I remember writing case study with John, and it was a good experience. But it's training, I don't see that.
yeah,
Somebody can just-
it doesn't just happen naturally, does it?
Poke, we had to learn the poke and see where the
Yeah.
decision points are.
Yeah,
It was a good learning method. For me personally, I like writing that case.
yeah. And it's been used very widely, so thank you. Yeah, but now we're going to retire it because we have the new one,
New one.
up to date.